in this podcast, we're going to go into some detail of how this is going to impact you directly, how it already has, and what is in store. And we do believe that there's going to be a recession.
Yeah.
There's going to be some inflation. So some things are going to happen. And if you know that they're going to happen, you can do some things now to prepare yourself and your family for when this recession does hit.
Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen, along with our co-host Anthony Faso, and today is August 15th, and it's a big day for us.
Happy anniversary.
50 years ago today, Richard Nixon took the United States off of the gold standard, and today we're going to talk to you about why that is important and what it actually means.
Yeah, which you might be thinking, well, big deal.
Yeah.
Right? It's been 50 years we're off the gold standard, and many of you thinking we're probably not going to go back.
Yeah.
Right? But I'll tell you why it's a big deal. In this podcast, we're going to go into some detail of how this is going to impact you directly, how it already has, and what is in store. And we do believe that there's going to be a recession.
Yeah.
There's going to be some inflation. So some things are going to happen. And if you know that they're going to happen, you can do some things now to prepare yourself and your family for when this recession does hit. Now, on the gold standard, Cameron, what's the big deal? Like, why? Well, what does it mean to be on the gold standard?
Yeah, good question. What it means, prior to 1971, what our dollars were tied to the gold standard. And what that means is that for every dollar we had out there, we had a certain ounce of gold backing that up. And so it was tied to that, meaning that if we wanted to have more money in circulation, we needed to have more gold in our possession. And so in 1971, what happened is Richard Nixon formally took us off of that standard, which allowed the dollar to kind of be created out of thin air, essentially.
Mm-hmm.
Yeah.
Yeah. Cameron, why the gold standard? Why not silver, or why not wood or metal, or why gold?
Yeah, so historically, right, gold has always been considered a precious metal, and it has been used for trading really, I would assume, since the beginning of time, right? And so there's always this inherent value in gold, and so that is really why we were put on gold, or used gold to establish the gold standard in the beginning. Anthony, can you give us a little bit of background on what led up to Richard Nixon taking us off of the gold standard?
Well, I'm going to answer this. I'm going to give two answers.
The right and the wrong one, or what?
The wrong one and the right one.
No, okay. Yeah.
Well, first I'm going to tell you what the government's reason was.
Okay.
And then I'm going to tell you what I think, in my opinion, what the reason was. And in the 70s, we were experiencing large amounts of trade deficits, meaning we had more goods going because we were buying cars from Japan, cars from Germany, wine from France. So we were buying more things than we were selling. So there was a trade deficit, which means some money was leaving our country to pay for that deficit.
Mm-hmm.
But some of these countries didn't want U.S. dollars. They wanted gold instead. And the government, and I don't blame them for this, didn't want money or didn't want gold leaving the United States. So what they did is to kind of give a finger to these other countries, says, you know what? We're going to be off the gold standard. No gold can leave this country, but you can take as many dollars as you want. And the way that this was framed is like, hey, this is just temporary. Mm-hmm. We just need to fix this trade deficit. And then once we get it, then we'll go back to the gold standard.
Anthony, you know what else was temporary?
What's that?
The income tax.
Oh, it's still around?
Yeah, still around. I'm still paying it.
Yeah, it's amazing. Whenever you hear the government say, hey, this is only temporary, grab your wallet.
Yeah.
Okay.
Cause for concern.
Yeah. Rarely is anything temporary with the government. But now what I think there may have been some truth on why we went off the gold standard at that period of time, but I can tell you the reason why we haven't gone back and why it's going to be difficult to go back is because the government wants to control the money supply, right? As we encounter wars or we increase government spending, that's going to take money. And if we're on the gold standard, we have to bring in that gold before we can print a dollar. But now that we're not on the gold standard, we can literally print money whenever the government wants.
Just turn on that printing press.
Exactly. But now, so now let's talk about, Cameron, what are some of the consequences of, or big deal, we're off the money, we're off the gold standard.
Yeah.
What does that mean to the average American?
What that means and what has happened since we've been off the gold standard is that the actual dollar has less buying power, right? And so we had discussed inflation in a previous episode, and I think now is probably a good fit or a good time to kind of bring that example up. We talked about candy bars, right? Anthony, if you had $1 in your pocket, when you were a kid, right, many, many years ago, is how many candy bars could you buy?
I could buy 4. They were a quarter.
Okay. So let's say you didn't take that $1 out of your pocket and buy candy bars then, but you kept it, and now you pulled it out of your pocket today and you went to the store and bought candy bars. How many could you buy?
I don't think you can buy a candy bar for $1. Or maybe if you can, it's a fun size.
Yeah, exactly, right? You actually make a great point there. One is the buying power has diminished over time, right? And that's what people typically talk about when they see inflation, is that each year when inflation goes up or there's more dollars being printed by the U.S. government, by the Federal Reserve, are being put into our economy, the actual purchasing power of every dollar goes down, right? And that's a cause for concern. The other way that you see it, or another example is, like you said, is the bite size, right? And a lot of times, especially recently with how much money the government has been spending, people talk about food inflation. And so you'll see the cost on certain products rising, and that's the price that moves. But what's funny is if the price stays somewhat static, you'll see that the actual portions are getting smaller and smaller. Right. And I remember when I was a kid, we'd go and we'd buy cereal at the store, and we used to have these huge family size ones. And these things were packed full of cereal. And now my kids buy them and they come in this huge box. But inside of there, that packaging is smaller and there's less product inside of it. So if the price is staying static, typically you're going to see that product getting smaller and smaller. Anthony, you gave a good example earlier when we were preparing for it.
Well, this gets me fired up because you know how much I love ice cream.
Close to home. Gets me mad.
Yeah. And I challenge anybody to go buy a half gallon of ice cream.
What do you mean?
I remember growing up, we used to buy the half gallons of ice cream.
Yeah.
But now if you go in there, you can't buy a half gallon. And I don't know what the unit of measurement is, but it's not a half gallon. It's slightly less. And you can see, I remember when this happened because I would like, this looks smaller. And then I could physically, because only a couple companies were making the less than the half gallon, but you can buy a half gallon from, say, Breyers, but another company was a little bit smaller. Yeah. You could just see them when they're right next to each other. But now everybody's doing that, right? And that's just an example of different ways that they're compensating for the inflation. If your goal is to have your passive income to be more than your monthly expenses, then you need to check out our summer series, which is why we entitled it Your Path to Financial Freedom.
Our summer series consists of 3 webinars where we're bringing on industry experts to share some of the best passive income business models that we've come across. We are putting them all here together to help you build wealth and create passive income without the risk of Wall Street.
See you there.
Take care.
Let's talk about what the government's been doing.
Oh my gosh. They've been spending money like crazy, right? I think when we were researching, you had come up with a stat on their national budget. Yeah. Do you have that available?
Yeah. What we had went and looked back on what the what the government was spending per capita. Okay, so per person in the United States, because our population has grown since the 40s, has grown by quite a bit. So you would expect the government spending to be higher.
Yeah.
Right. Now, this chart took into account inflation. Okay, but what the government was spending on average in the 1940s of about $3,000 to $4,000 per person. Okay, now this only went up to 2015, but in 2015 we were spending $12,000 per person.
That's crazy.
So that's 3 to 4 times more per person. And this is adjusted for inflation, so we can't just say the loss of the value of dollar. This is taking that into account.
Yeah, and you're giving an example on the amount of money that the government is spending, right? And when you spend money that you don't have, you've got debt, right? And if you go back and you look at it, here's one of the statistics that I thought really jumped out at me when I was preparing for this was in 1960. 10 years before we got taken off the gold standard, the federal debt was half the size of the economy.
Okay.
Right. Today, it is we're approaching 28 trillion, which is 130% larger than today's economy. That number or that spread has just blew me away. That is absolutely huge. There's no way that we, in my opinion, it's I'd hate to say that there's no way, but it's going to be very difficult for us to kind of come out of this.
Well, I agree. And for us to be more physically responsible, like something negative is going to have to happen.
Yeah.
I mean, that's the only way we're going to fix Social Security or where we're going to fix anything is in the dire moments.
Yep.
Right. So let's talk about what are some things, if we believe that there's going to be some dire things happening, Cameron, what are some things we can do now to prepare?
Yeah. When I think about those things, right, is doing some of this research, you look at this and you're like, man, this is not going to end well, right? Is however this thing plays out. But at the end of the day, for me personally, is, man, I can change what I do, my habits, the way that I'm preparing for some of these things to change. And the thought that keeps going through my head is I'm realizing that there's no incentive to save $1. Right? So there's no incentive for me to put $1 into the bank and let it sit there and then spend it, tomorrow or at a later date. And so my takeaway is, man, I got to accumulate these dollars and I need to turn around and I need to go spend it. And the way that...
Okay, spend it?
Well, spend it, or thanks for catching me on that one, is actually invest it, right? Is because when you invest, you want to go buy assets that are going to be a hedge against inflation. And so there's a lot of people that are taking dollars today and they just spend it like you'd mentioned. But really the way that we're going to get out of this is at an individual level is we've got to prepare, take these dollars and go invest it into assets that act as a hedge.
All right. So let's talk about what some of those assets are.
Sure.
Right. And we talk a lot about real estate, but real estate is a great hedge against inflation. What we want to be doing is buying real assets.
Yeah, good point.
I mean, assets that aren't created by man, but hard assets. And with real estate, there's a lot of different forms of real estate, right? But even if it's just land, I mean, land, there's only so much land.
Yeah.
I mean, and typically when there is inflation, things are going to cost more and those assets are going to go up.
Yep.
Which means appreciation on the land, but also the house. But then also with inflation, if you have rental income, your rental income is going to go up with inflation, right? So it doesn't need to be real estate. I know we talk a lot about real estate, but there's a lot of assets out there.
There are. And one of the things that kind of came to me, as I'd said just a minute ago, that savers are losers.
Yeah.
Right. And I need to clarify that, I think, is because where most people assume that somebody is saving money, right? You and I are saving money, right? Our clients are saving money, but we're saving it in an environment inside an insurance policy that is protected, is credit protected, but it's also guaranteed to grow. Right. And so these things are growing at 4%, around 4% annually every single year. And that in and of itself is acting as a hedge against inflation. And Anthony likes to make a good point is that inside of that policy, part of those that growth is coming from dividends from the performance of the insurance company. And if we're participating with the mutual insurance company, when they have increased profits or interest rates increase, those dividends are also going to increase, which will then get paid back in the policy. And so cash value life insurance is a great hedge in a cash position against inflation.
Another opportunity here with inflation is the ability to use leverage.
Yeah.
Which means leveraging ideally against an asset.
Yeah.
Which, whether that's real estate or your business or your home, you have the ability to take a loan at historically low interest rates. And that can be locked in for 30 years. Yeah. Or even if it's a business loan, it might be 10 years, but you have the ability to use that money use the money in today's dollars, but pay it back with the weaker dollars in the future.
I think a wise man once said on a really good podcast that you should leverage high, leverage long, and pay off slow.
The infamous Aaron Chapman.
The one and only Aaron Chapman, absolutely.
And let's clarify, because let's go back to how this affects infinite banking.
Yeah.
And with whole life. The way we're using whole life is we're using it.
Yeah.
We're not just saying, that you're just going to put the money in there and just not touch it. Mm-hmm. Even though for many people, that is a good strategy. I have a lot of clients who are like, you know what? I don't want to invest in real estate, or I'm not an investor, but I don't trust the stock market.
Yeah.
So this can be a healthy alternative. But what we're trying to challenge our clients to do is that the money has to sit somewhere.
Yep.
Right. And we ideally want it in a place that's going to earn more than the cost of inflation. It's liquid and that we have access to it. And that's why we store it inside a policy, but we want to buy assets.
Yeah.
So just so we were talking about leverage, we can also leverage against those policies to buy assets. Mm-hmm. So we have our money safe, but then we're also using leverage to buy assets.
Yeah. Specifically cash flow and assets. And I add that because when you look at the kind of the traditional plan of financial advising, it's all about deferral, right? It's all about putting $1 away today for tomorrow. And man, right, if you've learned nothing from this podcast or conversations about inflation, is that dollar is getting weaker by the day. And so it is more of a benefit to you to have access to capital now today and to be purchasing things and putting those dollars to work now today than it ever will be to put that off till 20, 30 years from now.
And, again, we talk a lot about Robert Kiyosaki, right? And his definition of financial freedom isn't having millions of dollars when you're in your 60s.
Yeah.
It's having that passive income being more than your monthly expenses. And I would hope during this whole issue we had with COVID, where a lot of people were off work or laid off or furloughed, hopefully that showed the importance of having some passive income, whether you call it a side gig or you have something else where we're not solely dependent on our job. And particularly if you think agree with us, like there's going to be a recession, and even Robert Kiyosaki, one of his latest book is called Fake, which he wrote in 2018, I believe, or 2019. But he had said that the longer the government props up the economy, the harder this is going to fall. And he expected this to be worse than 2008. For me, I sure hope not.
Yeah.
But it's really hard for me to contradict what Robert Kiyosaki says. So who knows what's going to happen? Mm-hmm. But what you need to start doing is preparing for it. You need to start having some sound assets. Start changing your mindset. Start buying some assets that are producing some cash flow.
Mm-hmm.
And if that's something you want to learn about, or maybe don't know where to start, or don't even know how infinite banking works, let's talk about it.
Yeah.
In the link in the show notes, we're having a discovery call. It's about 15 to 30 minutes where you can talk to Cameron and I, and we can kind of see, is infinite banking for you? What do you want to do, and how and if we can help you?
Yeah.
Right?
Absolutely. Hope you guys enjoyed this episode, and have a great week.
Go make it a fantastic day.